When you're trading, somebody else is making more money, either the trading apps or the government of India whom you're giving taxes. But when you are investing, you are seriously, in the business of compounding. The number of millionaires in India will be far more than what they are reported.
Okay.
Because maybe they are not getting captured, maybe we've got an unofficial economy which doesn't get reported.
Yeah. Traditional family wealth and all probably doesn't get reported.
Yeah. So I think 40,000 is not a realistic number of millionaires in India. It will be far more than that. Every good advice has to be forward looking. If your advice is on the basis of what has happened in the last 1 year, it is already dated because that story is already played out. So then you're buying into asset classes or assets which are already expensive.
How do the wealthy invest and what can we learn from them? That is exactly what we dive into today with Rohit Sarin, the co-founder of Client Associates. Client Associates is a wealth advisor to some of the wealthiest families in India, managing assets of around 60,000 crore. In this conversation, we not only talk about investment opportunities, but we also get a glimpse into how the wealthy manage their money. Welcome.
Yeah.
So you spent nearly 3 decades advising some of the wealthiest families in India, and Client Associates, the company you founded, manages around 60,000 crores in assets under advisory. So what are some of the key investing, what are some of the things that they do very differently, the wealthy families from regular investors?
Very good question. So there is a very big difference between which I have seen, how wealthy families, deal with when it comes to investing their money and a smaller investor, retail investor. So a retail investor will tend to get influenced by the near-term momentum. And so their investing decisions will be driven by the near-term momentum, so timing the market, futures and options. So the wealthy families do none of this, right? So because they are driven more by compounding their wealth over a longer period of time, right? Because they fully understand and appreciate, because that's the way wealth gets created, because that's how they've created wealth in their own businesses, which are built over generations. Right, so businesses also goes through highs and lows. So if a business is not done well in a quarter, so they will not sell that business, and if it is done well in the next quarter, they will certainly not ramp up the business. So I think that is the key difference, that they are more long term in their approach. They are more driven by compounding their wealth instead of being tactical or driven by momentum or timing the market, or certainly not futures and options.
So if you look at the Indian economic scenario, the macroeconomic factors are looking quite favorable. But if you look at the global markets, the markets are doing pretty well, but there's a lot of uncertainty. So there's geopolitical tensions and there's threats of a little bit of economic slowdown as well. So what have you been advising your clients over the past couple of years, and going forward as well, what are you advising your clients?
So I think we are living in very unique times. Like in my entire lifetime, I haven't seen, first of all, the uniqueness of the strength of the India's macros. And within that, if somebody has to ask me, that is one thing which stands out, is the inflation management in India. For example, very recently until now also, the retail inflation is sub 3%. At least in my lifetime, I don't have a memory when I have seen those kind of numbers. And then it has got a snowball effect on other macros. For example, your fiscal deficit, comes under control. Your current account deficit comes under control. If your interest rates are lower, then it has got a positive effect on a whole lot of other factors. So I think India's economic factors were never better than this, and they are expected to be in this zone at least as we can foresee for next 10 years. There are various reasons for that. While this is happening very uniquely in the India's context, also very uniquely geopolitically, the world is becoming increasingly fragile. And this is maybe more because of the tectonic shift which is happening in the global world order, because after the Soviet Union collapsed in 1991, the US emerged as the unipolar power center of the world. Now, over the last 20 years, China's emergence as an economic powerhouse has challenged that world order. So eventually, all these things are in some way are connected with that shift in the global world order which is happening, and because of which we'll keep on seeing these regional conflicts, and which will have an impact on the growth of the global economy. But if India plays its cards well, knowing that our own macros are doing very well, the global weakness can actually turn to India's advantage. Because just imagine in a world when there is a chaos everywhere, then everybody will gravitate towards a island which is at peace and calm, right? That could be India's opportunity. So what we are advising our clients is that, be long on India, because we feel genuinely with the kind of data that we get to see in our business that next 10 years, if not more, could be India's best years in this entire century. So this is a time for us to allocate towards India, participate in India's growth story. As India's per capita income will continue to rise, it will continue to place more disposable income in the hands of its citizens, which will create a consumption-led economy and a demand for all industries. So I think we are long on India, and currently more in the near term we are underweight on the US markets, because we feel that with the tariff policies with that country is taking, actually it can harm their own economy.
There's still a lot of uncertainty. Businesses are not, they don't know when to invest or how to invest, because policies can change overnight, I guess.
And this is also reflected in their own policymakers. For example, the Fed itself is not lowering the interest rates now. They're also waiting and watching, which will only happen if they themselves are not confident about the growth of their economy. So I think we are underweight on the US. China is going through its own challenges, so we are not recommending any allocation to that in any case. But India is where we are saying domestically you should be overweight, because that is where the growth is going to come from.
So you mentioned China. So China from 2010 to 2020 was like a golden period. There was huge economic expansion. So I think annually, if you look at it, there were around 5 to 10 lakh millionaires being created every year. Do you expect that sort of, and if you look at India, around last year, I think it was around 40,000 millionaires that were created last year. So over the next 10-20 years, can India expect a boom like that?
You see, directionally, certainly India's growth can happen that way. But even if you look at the numbers between the millionaires, say of 5 lakh millionaires happening in China and 40,000 here. So look at, China's economy roughly is about 4.5 to 5x of India's GDP, right? So if in a normalized scale also you do a 5x of that on 40,000, it's 2 lakh. When our economy will get to that stage, 40,000 will, in a normalized terms, should and must become 2 lakhs. It should grow to 2 lakhs. Besides that, my sense is that the number of millionaires in India will be far more than what they are reported. Because maybe they are not getting captured. Maybe we've got an unofficial economy which doesn't get reported.
Traditional family wealth and all probably doesn't get reported.
So I think 40,000 is not a realistic number of millionaires in India. It will be far more than that.
So when it comes to building long-term sustainable wealth, so how are millionaires or HNIs being created? Is it mostly because they have a successful business or a high-paying job, or is it down to investing?
So I think it's a combination. It could be a combination of all. All could be actually contributing to the growth of wealth. For example, traditionally, the wealthy in India have been, before India started even opening its economy 30 years back, was the industrial families. They were into manufacturing, and that's where the wealth actually was owned and resided. So if you are a family business owner, you are an entrepreneur, that's where could be the source of wealth traditionally. If you are a new generation entrepreneur, that's a source of clearly becoming a source of new wealth from new age companies which are coming up. Thirdly, also, as India's economy is growing, as the scale of Indian businesses are growing, the ability of Indian employers to pay is also going up, right? So even within jobs, if people are adding value to their organizations and they're growing up in their roles, that can also be is emerging as an alternate source of wealth creation. And lastly, if all three of them, whether they're business owners, entrepreneurs, or high-paying jobs, if they invest their savings and let it compound, that is the surest way to create more wealth. So I think all four of them actually are leading to increased affluence in India.
So client associates can be termed as a private CFO for wealthy families.
Yeah.
So can you expand on that, what that entails and what all services you offer?
So see, what happens is that, just like a CFO is there in a company, in a business, in a corporate. So what does a CFO do? CFO is a representative of the corporate. right? To do what all? To basically manage their books, basic accounting and taxation work. So they will work with the respective professionals to get that piece of the work done. Then if the company wants to scale up and they want to raise funding, either through debt or bank financing or equity capital, they will go out and engage with professionals to raise that. Even if through inorganic expansion, the corporate wants to do some acquisitions, so they will engage with investment banks who specialize in M&As to go and look at some acquisitions. So just like a CFO at a corporate level is the custodian of the corporate wealth, likewise client associates as a family CFO is a custodian of the family wealth. So what we are trying to do here is that we are trying to solve as many problems as possible around the family's wealth which the family wishes to solve, right? It could be investing, it could be ensuring that it is performing as per expectations. It could also be making sure that the risk is contained within the expectations of the family. It could also be helping the family plan the succession of the wealth in their lifetime. It could also be buying and selling certain real estate assets. It could also be leveraging against their assets to grow their wealth further, and whole lot of other services. So pretty much we work like a private investment office of a family, and most importantly we do this without having any funds or products of our own, because I think that is extremely essential to bring alignment of interest to deliver unbiased independent advice. So completely we are an open architecture. And because if you are a hospital, you should be a hospital, and you should not also set up your own pharma company, because then your advice will be biased, can never be independent, right? So that's what we are. So we completely sit on the same side of the table as our clients, as their family CFOs, and trying to do exactly what they would like to do with their wealth to protect and grow it.
So as I understand, client associates, the advice that you give is all very data driven. And can you give an example of how this plays out in real world, and what can retail investors learn from this? Can you give a few examples of the data-driven approach?
So we realize, early enough that, in the business that we are in, it is influenced on a day-to-day basis by emotions of greed and fear, because we all are humans, right? And not only our clients, even service providers like us can also be influenced by emotions of greed and fear. So when we are giving best-in-class advice to our clients, it has to be objective. It is devoid of any emotion. That is what objectivity is all about, right? So the only way you can achieve that goal is by giving advice which is driven by data, facts and figures, right? So we've kind of early on, we develop models which will help us to forecast the direction of the markets. Nobody can time the markets, but you can always, you can build models and algorithms which can give you a sense of the emerging direction of the market. How much is current risk in the market, how much is the emerging risk in the market, and then basis that you take decisions today in the context of an emerging scenario. Every good advice has to be forward looking. If your advice is on the basis of what has happened in the last 1 year, it is already dated, because that story is already played out. So then you're buying into asset classes or assets which are already expensive, right? And if you buy, the golden rule of succeeding in investing is that even if you buy the best asset in the world, you buy it expensive, you will never make returns in that. You will make a minus returns in that. So I think we basically look at, we built a multi-factor model which is built across 13 multiple factors, which includes domestic economy, global economy, valuations, liquidity, and so on and so forth, and the policy direction. And we look at the data, the latest data on a monthly basis, and then we put it into a model and tell us that what guidance are we getting out of that model, and basis that we advise whether we should be, for example, be overweight on equities, underweight on equities, or neutral on equities in terms of our exposure, our clients' exposure on that asset class. And then we also measure the efficacy of that advice, because if we say it's a forward-looking advice, then we also measure that what is the return which got generated 3 years from the stance that we took, because it has to be forward-looking. So what data tells us is that whenever our stance was neutral, and we've been doing this for last 10 years, and it's all documented and we publish it every month. that whenever our stance was neutral on equities, equity indices, they delivered an equity kind of returns, which is about 15-16%.
Okay.
Whenever our stance was overweight on equities, it generated an equity plus returns, which is, it could be anywhere between 18 to 20%.
Okay.
And whenever our stance was underweight on equities, it generated, if somebody would have invested in equities, then 3 years down the line, it generated equity minus returns, which is about 8 to 10%.
Okay.
Right? So the clients would have taken full equity risk, but they have actually got a debt plus or an equity minus return. So which is what we want to avoid our clients getting into, because
Okay.
we want them to earn a normalized return if they're taking a normalized risk of an asset class. So that is how data-driven strategies, they help us to, advise our clients to stay at the top of the game.
So can you give a few examples? Suppose you see a certain trend going on in a certain industry, and you see, the economic factors, they're looking good in that industry, so you advise your clients to invest in that industry?
Yeah, so first of all, see, we are not picking stocks ourselves. So we are asset allocators and manager selectors and risk managers. So when we construct a model portfolio, say in equity, so we are constructing that model portfolio across active managers, right? We still believe that active investing can create outperformance and alpha, which is our track record also demonstrates. So we construct portfolios across active managers. And when we are identifying active managers, then it is aligned with our forward-looking view on industries and sectors also. For example, till about 1.5 years back, our view was that we were overweight on private banks, which had not participated in the rally. Right? That call has played out very well in the last 1 year, right? Because they had not participated in the overall rally. Even the large cap indices, they had underperformed the large cap indices also, right? So those kind of forward-looking calls, based upon on what our models are guiding us, we will take, and then we will construct our portfolios which are then aligned with that house view.
Client Associates has been advising families for over a couple of decades.
Yeah.
So can you give examples of how you've compounded wealth for wealthy families? Maybe without naming names, maybe say a few stories.
So one way of giving that answer is, I can tell you, is, thanks to our vintage of 23 years, now we work with several families in the second generation, right? So that is also one way of compounding, because the relationship is growing. If the trust is there, then only it goes on to the next generation. There's few families we also work in the third generation now.
Okay.
Right? So that's also another sign of further compounding, because see, these families would be choosing to work with us because only if they've seen their wealth compound with us, right? And every generation is smarter than the previous one, right? It's not that the previous generation was not smart enough. They were smart for their times, but the next generation is multiple times smarter than the previous generation, because they've grown up in different times with different exposure. So if every subsequent generation is choosing to work with client associates, and they are smarter than the previous generation, then that would be possible. My guess is only if they would have seen that the family's wealth has compounded over a period of time. So I think that's a kind of a validation that, we have helped our families to compound their wealth. And I think one of the best ways in which we must have done that is that helping families to stay in the game. For example, events will keep happening. When COVID happened, so we know there was a fear factor everywhere, and there were certain clients which were into businesses, they were into consumer businesses, and lockdown happened, those businesses shut down, and suddenly there was a quarter when these businesses actually were getting into operational losses. And suddenly, parallelly, the markets were also tanking, and they were down 30-odd%. And when you see that your investments are going down, when you see your business is also going into operational losses, then the families will definitely, the fear factor will catch up with them, because at the end of the day, we are all humans, right? So they wanted to cut their losses at least on their financial portfolio side, and then we advise them to stay in the game.
Okay.
Because what has happened is that definitely life has come to a standstill, but this is not as bad as a war. Because when a war happens, then what happens? There's a collateral destruction happens. When a bombing happens, infrastructure will get damaged and everything. You have to rebuild that. In this case, that hadn't happened. Only the operations had stopped, and that also for a short period of time. So when the life will, start moving again, then the cash flows will start moving again. So and I think These clients were, they trusted us, trusted our advice. They stayed in the game. They did not pull out the investments, and the markets came back. I think 21, 22, 21 particularly was one of the best years they would have seen their wealth compound.
Talking about wealthy families, so that's one thing I wanted to ask. Is their attitude towards very different? Is it so? Are they more well informed and more patient when the markets go down, or are they a little more demanding?
So definitely they are more well informed, and because what happens is, when you are running a business, so then your exposure about the macro data is a lot more, because you're seeing how the economy is moving and you're seeing that in your business. So certainly they are more well informed. Secondly, as I mentioned as my answer to one of your earlier questions also, that they are long-term players. So to a long-term player is like a marathoner, right? And the only way somebody can finish the marathon, forget about winning, is to stay patient till the end of the marathon, right? So have you come across any sprinter who's won a marathon? No, because nobody can survive even half a marathon at the speed of a sprint. So I think wealthy families are like marathoners, and they've been in the game for the longest period of time across generations, and patience comes in naturally to them.
Okay.
And if you combine the virtue of patience with they being more well informed, so they are able to stay in the game as compared to any other investor, who may get out of the game and then miss out on compounding.
An advantage high net worth individuals have while investing is they have access to exclusive investment opportunities. So, for example, here in Kerala, Viju Jacob is one of is a leading industrialist over here, and he had an early opportunity to invest in SpaceX, Elon Musk SpaceX.
Sure.
So, do you? And I think he's sitting on handsome returns now because SpaceX has done really well.
Certainly, yeah.
Yes.
Yeah.
And so, do you actively seek out such early stage investment opportunities or off market investment opportunities for your clients in India and abroad?
No, certainly. I'm glad you asked me that question. It is such an important question, especially in the current times when you must be reading as a media house. There's so much of frenzy of investing in unlisted and pre-IPO and all that. So that's the kind of a momentum-driven froth, which we don't participate in, right? But yes, having said that, as India's economy is growing, there's a lot of action also happening, growth-oriented action happening in the unlisted space. So, because we are like a multi-family office and we work with 1,300 plus families, we have got access to a very vibrant ecosystem of opportunities where we get some very high quality deals in the unlisted space, which we bring to our families, right? And currently also, we are working on an unlisted business, which you mentioned SpaceX. So this is like India's SpaceX, right? Which could be India's SpaceX. And it is, so we're bringing that opportunity to families who have an appetite to participate in opportunities like this. So definitely our quest is to constantly look out for genuine long-term wealth creation opportunities and not short-term momentum-driven froth. Because wealth gets created only out of a marathon and not a sprint.
So you have a dozen offices across India and one in Kerala as well.
Yes.
What sort of attitudinal difference do you see in wealthy families across India, in Kerala and rest of the country? Their attitude towards risk, investing and wealth management?
Yeah, no, interesting question. So see, of course, in the larger metros to begin with, Mumbai, Delhi, Chennai and Bangalore, so their exposure to investing and other opportunities was definitely much ahead of the tier 2 cities of India. So their understanding of growth asset classes like equity or even unlisted equities is ahead of the exposure which wealthy families based in the tier 2 cities like say Kochi, Coimbatore, Ahmedabad, Pune could be. But having said that, we live in a wired world today, right? And everybody is well traveled, everybody's business is really not only domestically integrated but also globally integrated. So everybody is learning and learning quickly. So even the families here, although they are still rooted in a more traditional way of thinking, but the younger generation here is actually learning the new trends, and they also have a desire to learn and learn it fast.
Yeah, very global perspective also. Right?
Global perspective. Yeah. So I think while they have relatively lesser exposure to families living in the bigger metros, but they have a desire to come up the curve, and they're very open about understanding the opportunities which are available. And risk-taking capacity is there because, see, fundamentally the traits are the same. If they are from business families, they are wealth creators, they are well informed, they are patient. Maybe their exposure may be relatively lesser, but they want to bridge that gap by their desire to learn what they have not learned till now. So that's why we find markets like Kochi and regions like Kerala very, very exciting, because the rate of growth here could be faster than established markets like Mumbai and Delhi.
Okay.
Right. So these, as I say, these are like emerging markets for our business. Where while those are established markets, these are emerging markets, and there's so much for us to learn, from these markets. When we talk to entrepreneurs and business owners here, there's so much to learn from them, that how they are scaling their businesses. So I think we are getting there.
Many of your clients are all HNIs, and for retail investors, what advice would you give them so that they can take the next step up and invest wisely to reach the HNI level?
So I think for retail investors, again, the simplest advice is focus just on compounding your wealth. So become an investor, and instead of becoming a trader. So instead of timing the market, instead of going to trading apps and doing FNOs, just do SIPs, right? And do that over the longest possible time. That is the surest way of creating wealth, right? Because when you're trading, somebody else is making more money, either the trading apps or the government of India, whom you're giving taxes. But when you are investing, you are seriously, in the business of compounding. Right, so that would be my advice to them, especially for retail investors. They may not have access to quality wealth management advice because of the economics involved. So I think SIP is the best route for them to really build their wealth as India, grows, our economy grows over the next 10 to 20 years.
So what all investment asset classes are you advising your clients to invest in right now and going forward?
So yeah, answer to this question, first of all, has to be very customized. It has to be very unique to each individual circumstances, risk appetite, desire for the return at which they want to grow, and also the acceptability of the volatility. But having said that, the broader principle is you look at that how much, what is your asset allocation going to be, which basically means at a very macro level, what is that split between growth assets and protection assets which you want to have, because of your circumstances and your personal preference. And once you have figured that, then within growth assets, you look at listed equities, and if your scale is large enough, then maybe unlisted equities. And in protection assets, you basically look at asset classes which will give you a very predictable return at a very high liquidity. Although that return will be much lower than growth asset classes, but return is not why you're going there. You're going there because of two reasons, which is the predictability of the value of your investment, even on a short tenure, and second is liquidity, which is available. So that's how we advise our clients.
So gold has been an investment class that has been the superstar for the last 2 years, I feel. And down here in the south, a lot of people are very heavily invested in gold. What is do you expect this sort of run to continue?
So gold, if you see, gold is a great, as an asset class, as an asset, is a great diversifier. Right? In the last 2 years, I appreciate and I completely agree with you that it's outperformed any other asset class, given very handsome returns. But if you look at a 10-year cycles, if you look at a 30-year cycle, then gold has perhaps given 10.5%, 11% kind of a CAGR, whereas equities would have given you about 14-15% kind of a CAGR. So gold will, in terms of return, will give an equity minus return. But what it does is that its correlation with equities is very poor. So when equities are doing well, gold is not doing well, and vice versa. When gold is doing well, equities may not be doing well. So it's a great diversifier to a portfolio.
But gold as a hedge, is that becoming, it's not working out anymore, right? Over the past few years, they've been kind of interlinked, correlation has been a little higher, right?
In short periods of time, yes, but generally if you see, when does gold do well? Gold will do well when there is uncertainty, so, right, gold will do well when inflation is higher, right, and that's generally when equities will not do well. So there is a reverse, correlation between equities and gold. So it's a great diversifier, and also it gives you a healthy return of 10-11% in the past on a longer term return. Short term, it has given very handsome returns. So I think about 5 to 10% in your portfolio, it makes sense to have gold, and because it can bring down the overall portfolio volatility.
So for a young investor who is setting out to invest, what sort of, and they have a decent risk appetite, what sort of portfolio asset allocation do you advise for a retail investor?
I think your asset allocation should be a function of combination of various factors, but largely which you can prioritize. Any investor can prioritize is, first of all, what is the time horizon which you have. So longer the time horizon, then everything should go into equities, because the simple logic that equities in the longer time horizon will outperform any other asset class. So even if you're going to invest in gold and equities is going to give you a 3% higher return than gold over a 10-year cycle, then why would you like to lose a 3% per annum compounding on an asset class for 10 years, right? But then there is a second factor which every investor has to do a balancing act, is what volatility you are comfortable with. If you put all your savings in equity, then naturally you'll have to be comfortable to digest the volatility of an equity as an asset class. If you're not comfortable, then you'll have to balance that with something like a gold or a fixed income, because they will not go up and down in a similar manner as equities are going down. So, but if you are a growth-oriented investor and you're comfortable with volatility, because you know that this is just a mark-to-market volatility, you do not need these funds, then equities is the best asset class to compound your wealth, because they are going to give the highest possible return over a longest possible time.
In India, do you see any sectors that are poised for great wealth creation in the coming years?
See, as India's economy will grow, that growth will mirror in various sectors of India. So first of all, the biggest contributor to the GDP, which is almost 60%, is the consumption-driven sector. So naturally, as India's economy will grow, as the affordability of Indians will grow, that will drive the consumption-driven businesses, because their demand will grow up. So market expansion will happen for those businesses. So clearly, an exposure towards consumption-driven businesses, right, definitely will lead to wealth creation. And we see that happening everywhere, even in consumer brands, people who are simple products, but they build consumer brands, they have really grown over a period of time. Then the second area where India economy will get mirrored, India's economy's growth will get mirrored is in the infrastructure side. Because as we know, government of the day is, doing capex for the last 2-3 years and to ramp up our infrastructure. When that happens, that's a source of business for many companies who are the ones who get that business to build that infrastructure. So I think that's a second area where the investment-led growth in the economy will lead to growth in wealth creation, because those businesses will scale because of that capex happening in the economy. And if those businesses will scale, their earnings will scale. If the earnings will scale, then their stock prices will mirror that growth, and which will lead to wealth creation through those businesses also. So I think predominantly consumption and investment-driven, capex-driven industries will mirror India's growth and lead to wealth creation.
In the current economic scenario, are there any industries you are underweight on?
See, that's currently, yes, everything else is growing, but when you markets go through cycles, sectors go through cycles, so that will keep on happening. So I think if we were to be underweight, then we may be underweight on sectors whose valuations really run up fast, much faster than the rate of growth of the underlying earnings of those businesses. For example, maybe in 22 and maybe in 23, PSUs, they grew really fast. But the re-rating in their valuations was much faster and much higher than the growth in the underlying earnings of those businesses. Likewise, some of the defense stocks, they really grew pretty fast in 22, 23, even in 24. So wherever, industries and sectors where their valuations have grown faster than the growth in their earnings, we would be underweight on that, because eventually the stock prices will converge around the rate of growth of the earnings in those businesses. So if your stock prices have grown faster than the growth of earnings, then it will kind of either by way of a time correction or an immediate derating will correct. That is bound to happen. So those are the sectors we would be underweight on.
Over the past couple of years, midcaps, there was a lot of froth in the midcap space. And there was a correction, but it's back up again.
Yeah.
What is your take on the midcap space?
If you see post-COVID, when the liquidity-driven rally came, and the maximum impact of that on the valuation came on the small and mid caps, and then that rally had continued, the overhang of that rally, and while the correction which we were expecting a mean reversion to happened, from October onwards, the trigger of that was the stimulus announced by the Chinese banking system. And in those 5 months, both small and mid caps, they corrected, by a reasonable extent. But still, while small caps have corrected relatively higher as compared to mid caps, but mid caps are still at about a 15% premium to their long-term averages. 15 to 20% premium of the long-term averages, while large caps are pretty much available, around their long-term averages. Small caps are marginally available at a marginal premium to the long-term averages. Mid cap is still, available at a higher premium. So that's a segment again to either avoid or within that pick up those such businesses whose at the business level, the valuations are still not run ahead in the context relative to the growth of their earnings.
So thank you so much for joining us. Wish you the best ahead.
My pleasure. Thank you for inviting me. Thank you.